What is going on, guys? Welcome back to the channel. My name is Tyler. Margin calls are getting very close for the hedge funds and institutions that we know are severely over leveraged. So let's go over in this video how low the markets are gonna have to go to see these margin calls, what will happen for AMC stock when these margin calls start to go out and as the market is selling off. Also, we're gonna go over the ortex data as well as a little bit of the technical analysis of AMC. We also do have to talk about the fact that Citadel did return 18% in the month of September with a portfolio value of $445 billion as well as over 13,000 open positions. So this is furthermore leading me to believe they are one of the hedge funds that are severely over leveraged on margin. So bye Citadel. Let's get into this video. Tap, tickle, touch, or smash the like button. Consider subscribing to the channel, and with that, let's get straight into it. So AMC did drop down about 4.39% today, and after hours down 0.14%, but considering the markets did drop significantly, right? The Nasdaq down 2.14%, S&P down 1.3%, the Dow down about 1%. This was not a bad day for AMC. We are not cratering. This is really a very volatile consolidation phase, like we did see on Thursday when we did pop up about 15% at the higher end, closed up about 8% on the day. Now we are down 4.39%. All in all, pretty much a consolidation phase. You're not seeing apes selling out of their shares in a rapid fashion, which is a great thing, but the markets are going down. So the hedge funds, institutions that are severely over leveraged are really the ones that are feeling a lot of pain. And if you guys are unaware of how margin just does work, let's just briefly go over it. So in short, a margin call occurs when the value of an investor's brokerage account falls below the broker's required amount. This is when a broker demands that an investor deposits additional money into their account so that it meets the minimum requirement. Now, it all depends, what kind of stocks, what kind of positions you are in, as far as how much margin you will have to put in, how big your margin call is. So take for an example, if somebody in the S&P 500 index fund compared to somebody that is shorting AMC, you're going to have to put a lot more money into your account to satisfy your margin call for short positions or just risky positions overall rather than safer positions. But these hedge funds and institutions, they're out for yields and gains. That's why we see pretty much all hedge funds and institutions over the last 18 months have went up either 1x or 5x in total portfolio value. This is only possible due to extreme amounts of margin. And if we do pull up the total margin debt in America, you can see that we just had these numbers actually be reported for the month of August, and this did come in at yet again another all-time high, $911.5 billion worth of margin debt. This is almost $1 trillion. A majority of this is held by hedge funds and institutions. But I know some of you guys are going to talk about, hey, you've talked about margin calls before, and yes, we hit the last margin calls on the head. So that is no surprise if you've been following this channel. We were correct on that when we went from about $30 up to about $50. We called that on the head. I'm not trying to say this is going to happen very soon. It's going to play into, what the overall markets do. There is a lot of negative things going on in the markets, and it does look like we are headed to the downside quite substantially over the next coming week. So I'm not saying it's going to happen tomorrow, but let's say the markets did crater tomorrow. Hedge funds and institutions have on average in between about 2 and 5 days to oblige for these margin maintenance levels in their portfolio. So it's not as if, the markets would crater tomorrow and they would instantly be hit with a margin call or forcefully liquidated on their positions, whether long positions or short positions. That's simply not how it works. They have a certain amount of time, and I would go out on a limb to say that, me or you have about 3 days to cover a margin call to deposit more money into our brokerage accounts when we do get a margin call. But the fact that hedge funds, institutions, they have more money, they do more, borrowing on margin with these prime brokers. So obviously they're probably going to have a better preference to them, probably more time to put money into their positions. But I don't think this is going to be a sell-off and then a quick bounce back up. This is going to be probably a very slow sell-off in my personal opinion, just because some of these events that are really bad for the markets are going to take some time to pan out. But just like we've seen with Archegos back here, if we pull up the Nasdaq back in March when shit was basically hitting the fan and Archegos did get margin called, they had a 1 to 8 times margin ratio. So they had 8 times more margin than they did have for, you know, actual assets in their portfolio. Now, something that I want to point out is this is the 200-day moving average, this teal line right down here under the orange and the blue line, or the, you know, royal blue line. This is the 200-day moving average. A lot of hedge funds, institutions did start to get margin called when we did drop on the NASDAQ under this 200-day moving average, or at least flirting with this. If we do pull out the SPY right now, we do have some ways to go before we do get to this 200-day moving average. So in short, that's where I think you're going to start seeing a lot of the first round of margin calls start to go out. And I will go ahead and put a horizontal line right here just to show you guys for a reference how much further we are going to have to drop to see some of these margin calls start to go out. Now, if we continue to drop the way that we are, it's definitely not going to take a lot of time, but I don't expect it to be as volatile going ahead into the future, even though some events could totally crater the market. If the debt ceiling does not get raised, we are in for some major pain. But that is what you guys need to know from the overall, you know, margin call situation. But what would happen with AMC stock? Obviously, as the markets continue to go down, you would see AMC go down as well. I don't think we would full out crater, probably go to about $30 per share, flirt with this prior support level that we did see back in early August, and at the worst case scenario, go down to about $20 per share. That is a great thing in my personal opinion. I would acquire a lot more shares than I have recently been acquiring. I have, you know, bought about 50 shares in the last, the last week, really, since we sold off from about $53, but I would buy much more shares if we were at $20 or even $30 per share. You just get more bang for your buck. So if that's the way that you guys look at it, then you would welcome a sell-off. Now, you have to remember to be patient with AMC, but great things are coming with this whole margin call situation. In particular, the hedge funds, institutions, they're going to be forced to cover on their short positions when these margin calls do come out, just because they take a lot of collateral to stay in, and to release that collateral, you have to cover on your short positions. That's just how it works. Now, let's talk about the fact that Citadel did return 8% in its flagship fund in the month of September. Now, how is this even possible if they have a portfolio value of $446.7 billion with 13,568 positions? Some of these are going to be long positions, some of these are going to be short positions. I personally think Citadel is one step away from seeing a massive margin call, because if you guys logically think about this, I'm sure there's a way to do some math on this, but you would have to have 13,568 positions that would return you an average of 8%. When the markets are dropping, Citadel is more than likely the one that is shorting the shit out of the stocks on the markets. Now, if we were to see a bounce instead of that, you would see Citadel essentially get screwed right over. But just the fact that they are returning these kind of percentages on, current positions of 13,568 and $446 billion, it leads me to believe that they are very leveraged on margin. And as we do know, they have increased their total portfolio value about $250 billion since about June of 2020. So I don't think it's even possible to have so many current positions, or just positions in general, usually staying at about 13,000 positions, and be, 1xing your portfolio value in just 18 months. It seems highly unlikely 13,000 positions would return you over 100% a piece. Some are going to lose, some are going to do better than 100%, but on average 100% does not make a lot of sense unless you are over leveraged on margin. And something that I want to point out is right here. It says hedge funds use leverage in a variety of ways, but the most common is to borrow on margin to increase the magnitude or bet on their investment. Futures contracts operate on margin and are popular with hedge funds, but leverage works both ways. It magnifies the gains, but also the losses. So once you do see these market see these markets, the market continue to sell off, it's going to magnify the losses. Like I said, watch that 200-day moving average to see the first round of margin calls start to kick in for a lot of these hedge funds and institutions. So that's what you guys need to know from this situation. Hopefully it cleared the air on what to expect with AMC, when margin calls could come. If the debt ceiling doesn't get raised by October 18th, you're looking at automatically a 30 to 50% decline in the overall markets, which is not something you necessarily want, but that would cause the MOAS pretty much simultaneously. So that's what you guys need to know. Hopefully it cleared the air for a lot of you guys. And also, before we do get off the topic of margin calls, I want to point out the fact that some people think that just because hedge funds, they hedge for the downside. Not all hedge funds are good at hedging to the downside. Some are going to make money, some are going to lose money. But if you think about it, if one fund is making money, one is losing money. So it is a net difference, considering we have a lot of short sellers of all different portfolio value ranges in AMC. It's not going to matter if some make money and some lose a lot of money. Overall, they're going to be forced to cover if we do see a massive drop in the markets. That's what you guys need to know. Hedging does not make hedge funds rich. Some are going to win, some are going to lose. It is a net neutral. It is a net neutral. So that's what you guys need to know from that. I just want to clear there. I see a lot of comments saying hedge funds are just going to get rich. They're going to make billions. That's not the case. That's misinformation. That's simply not true. Now, the short interest percentage of free float is 20.38%. The share utilization is at 85.23% as well. So there is a lot of shares that still can potentially be sold short into the open markets. And I do think hedge funds, institutions are going to screw themselves by thinking AMC is an easy target when the market does sell off. We are seeing a lot of resiliency right now, but I don't think hedge funds are going to see that the same way, and they are going to drive down the price, but they are going to drive up the short interest at the same time by doing all of this shorting as the market does continue to decline. So that's really what I want you guys to fully understand. There is going to be a price decrease in AMC if the markets do come down, but you just want to see that short interest continue to climb, which would happen. Now we are seeing 104.01 million shares that are sold short, as well as the days to cover is still going up at 1.32 days to cover. So you're seeing less volume. It's going to take more time for these short sellers to all get out of their positions if they wanted to, all at the same time. So you want to see the days to cover going up. That just means you could see a prolonged squeeze. The price would go higher before these shorts are actually able to get out of their short positions. Now the free flow on loan is 22.12%, meaning it stayed relatively flat over the last 7 days, but there still is about a 2% difference between the free flow on loan and the current estimated short interest, meaning the short interest can still continue to climb. My end of week price target, short interest target is about 21%. So that is really all you guys need to know. Let's just briefly talk about the AMC technicals as well, where we do currently sit, and we're still flirting with about $40 per share. We're at $36.77, but really in between about $30 and $40. It's not too bad. If we do drop under 30, that's where we're really going to break out to the downside under our support level. Like I said, at about $30, that's where it starts to get really bad, and then $20 is looking more likely. But I do think we will pretty much consolidate in between 30 and 40 if the markets do continue to sell off. But this can be very explosive, like we did see last Thursday, and I would not forget the way that AMC moves. It's very volatile. You guys better strap in and be ready for the ride. Lower the share price does go on AMC, the more shares that you can acquire, and that is exactly what I'm going to be doing. So that is what you guys need to know from this video. Hopefully you guys got some value out of it. It gave you an insight into what potentially to expect, when we will actually see hedge funds get margin called, as well as what will happen with AMC stock. So drop that like on the video, consider subscribing to the channel. Let me know down below in the comment section what you guys think about this margin call situation. And with that, you guys enjoy the rest of your day, and I will see you in the next video.